Dear students, we will do module 67. Module 67 is about section 54F part 1. Section 54F is an important section in capital gain, and it is first part. In the part 1 I am explaining the theory, part 2 I will be explaining the problems. So here, exemption for capital gain under section 54F part 1 we will deal. So what is section 54F? Section 54F, if you have to remember, if you are selling any capital asset other than a residential house property, but you are making an investment in a new house property, then you can claim this exemption. Any other house property, any other capital asset, meaning it can be jewelry, plot of land, furniture, anything, shares, securities, anything. It can be anything. But we have to remember the condition. You are selling any capital asset other than a residential house property, but you are making a new investment in a new house property. So now you know that we can have two house properties as per the income tax provisions. So conditions who all can claim. Only an individual or HUF can claim this exemption. And second condition is it should be a long-term capital asset. Then it should not be a residential house property. Then it can be a plot of land, commercial house property, gold, shares, or any other asset. Now the taxpayer should purchase a residential house property, old or new. So you're selling a capital asset, but you're making a new investment in a residential house property. Either they can construct one within 3 years, or buy one within 1 year before or 2 years after. This I have already explained, because when you are investing in a residential house property, you will start planning. So when the builders will announce that in launch of the project itself, you can make the investment. Second is 2 years after the sale. Then you have the money, you can think about it and you can do that. Or if you're constructing within 3 days, within 3 years, you have to construct that. So the construction of the new house property, 3 years. All sections, this 1 year before, 2 years after, and for construction 3 years. So it's easy to remember. So this exemption is available. One more condition is there. On the date of transfer of the original asset, taxpayer does not own more than one residential house property. See, I told you, SSC can have only two house properties. So when you are investing in new one, only you have one house property in your name. Now, how the exemption is calculated? Amount of exemption is calculated using the formula LTCG into amount invested in the new house property. Amount invested in the new house property divided by net consideration. Net consideration. Amount invested in the new house property divided by net consideration. So this I will explain when we are doing the problems. There are two types of investments possible. One is, imagine if the sale proceeds is 20 lakhs 20,000. 20 lakhs 20,000. 20 lakhs 20,000. Now expenses on sale 20,000. That meaning net sale consideration has become 20 lakhs. Now imagine index cost, less index cost. Less index cost. We are taking an example, 14 lakhs. So the long-term capital gain is 6 lakhs. Long-term capital gain is 6 lakhs. Now SSA has got two options. One is he can invest the entire net sale consideration. That meaning full 6 lakhs he need not pay any tax. Imagine he is investing only 80% of this. 20 lakhs. That meaning 16 lakhs is investing. That meaning exemption will restrict to 6 lakhs into 80 by 100. That is 4 lakhs 80,000. Now, if more than one asset is sold, computation is different. This is only when one asset is sold and invested in a new house property. We will do problems in the next module when more than one asset is sold. So, limit of exemption also you have to remember, it's restricted to 10 crores from assessment year 24-25. So, two residential house properties we can have, and the maximum amount of exemption you can claim is 10 crores. Now, capital gain account scheme. This is one section where income tax department is allowing you to invest in capital gain investment scheme, because residential house property and all, you cannot make any immediate investment. You have to think a lot of factors, you have to think about lot of factors, then you have to decide where to invest, when to invest, all this. So if you're not able to utilize or invest that amount till the date of furnishing of the income tax returns, what you can do, you can invest that amount in the capital gain account scheme. But there is a lock-in period. You can utilize only for constructing or buying the new residential house property. Now, exemption is not available if assessee owns more than one house property on the date of transfer, or if he purchases any other residential house property other than the new asset within a period of 1 year, or if he'll construct a new house property within 3 years. Now, any income from such residential house other than the residential house owned on the date of transfer of the original asset is chargeable under the head income from house property. Now, what are the consequences? Consequences are same. You have to retain that lock-in period is 3 years. So, if you are selling that asset before 3 years, already you have claimed LTCG exemption. Plus, when you are selling before 3 years, it will be short term or long term. If you're more than 2 years, it will be long term. If it's less than 2 years, it will be short term. So, short term or long term together will be taxed in the year of transfer. So, these are the consequences. So, this is what I wanted to explain in this module. This theory is very important. Computation, I will explain in the next module where more than one asset is sold. If one asset is sold, it's very easy because I have explained with that example. If more than one asset is sold, computation is simple, but it's a little tricky. So, I'll explain it properly. You will be able to understand. Happy learning. Thank you.